I want to talk with you today about something that may sound deeply counterintuitive, especially coming from someone who has spent a lifetime studying capital allocation and risk cash. More specifically, I want to explain why the savings account you likely view as the safest place for your money may quietly be the most dangerous asset you own. I can already hear the objections forming in your mind. Cash does crash. It does swing wildly with the stock market. It federally insured, liquid, and available at precisely the moment you need it. All of that is true. But safety and intelligence are not the same thing, and confusing the two has cost people enormous amounts of wealth throughout history. Here in early 26, I see millions of people repeating a mistake I witnessed many times before. They believe that because cash feels safe, it must also be wise. Numbers tell a different story. Walk into a typical American bank today and you will earn roughly 0.29% per year in a standard savings account, less than half of 1%. If you are more diligent, you might find a so-called high-yield savings account offering 4% or even 5%, which sounds respectable until you introduce the variable most advertisements quietly ignore: inflation. Inflation represents the steady erosion of purchasing power, and it currently sits around 2.7% annually. Economists expect it to remain in that range, if not climb slightly due to rising wages, persistent supply pressures, and the possibility of new tariffs. When you subtract inflation from your savings yield, the truth emerges. A 4% account earns you about 1.2% in real terms, while the average savings account guarantees a loss of more than 2% per year. Your balance may rise, but its ability to buy food, fuel, healthcare, or housing steadily declines. That is why cash is dangerous, not because it collapses dramatically, but because it decays quietly, like a slow leak in a roof. The damage is invisible until the structure gives way. I've seen this play out repeatedly. I bought my first stock in 1942 at the age of 11, and since then I've lived through booms, busts, manias, and crashes. The most devastating financial mistakes are rarely dramatic. They are usually committed by people who believe they were being careful. If I pulled a dollar bill from 1980 out of my desk drawer today and told you I'd put it in a savings account back then, you might be impressed that it grew to $8 or $9 with compound interest. But that same dollar would need to be worth about $4 today just to maintain its purchasing power. And everything from cars to gasoline to healthcare now costs multiples of what it once did. Cash preserved the number, not the value. That distinction matters more than most people realize. Now here, where the story becomes interesting. If instead of parking that same dollar in a savings account, I had bought a small piece of a productive business, one that makes something people need or provides a service society relies on, that dollar would likely be worth 50, 100, or more today. Why? Productive assets adapt. A farmer can charge more for crops when prices rise. A company with a strong brand can raise prices without losing customers. Businesses that create value have pricing power, and pricing power is the antidote to inflation. Cash has none. It simply sits there representing a claim on future goods and services while the amount it can claim shrinks year after year. Recently, I've been criticized for holding a large amount of cash at Berkshire Hathaway between $50 and $400 billion. People ask how I can call cash dangerous while holding more of it than Apple, Microsoft, and Google combined. It's a fair question, but it reflects a misunderstanding. Berkshire has cash, is not sitting in savings accounts earning fractions of a percent. It has invested in short-term treasury bills yielding around 3.6%, nearly 9 times what the average saver earns. That yield alone will generate roughly $9 billion in interest this year, with virtually no risk. Even so, that return barely keeps pace with inflation. We are not getting rich on cash, we are waiting. And waiting has a purpose. We hold cash because current market prices often fail to reflect long-term business value. When stocks trade at 1 times earnings on average, and some technology companies trade at 30, 40, or even 50 times earnings based on optimistic projections, patience becomes an asset. I've seen this before. In the late 1990s, investors believed the internet justified paying any price for any company with a website. The internet did change the world, but most of the companies people bought at extreme valuations disappeared or stagnated for decades. I saw the same pattern in housing before 2008. Prices rose because everyone believed they always would until they did. Valuations matter. What you pay determines what you earn. Berkshire holds cash not because cash is attractive, but because overpriced assets are worse. When prices fall, and they always do, eventually cash becomes opportunity. But this logic applies very differently to an individual saver earning 0.4%, while inflation runs at 2.7%. That saver is not waiting strategically. They are bleeding purchasing power. Cash can be a tool, but only when used deliberately and temporarily. Let me slow this down and really sit with inflation for a moment, because unless you lived through a period where it meaningfully reshaped daily life, it's easy to underestimate just how destructive it can be to people who believe they are doing everything right. I vividly remember the 1970s, not as an abstract chart in a textbook, but as a lived experience. Inflation did arrive all at once. It crept in quietly, starting at 3% or 4%. Levels people shrugged off as manageable. Bank accounts still paid interest, salaries were rising modestly, and life went on, but inflation has a compounding nature of its own. By the mid-1970s, prices were rising 8% or 9% annually, and by the end of the decade, inflation had surged past 13%. That meant that every dollar sitting idle in cash lost more than a tenth of its value every year. Imagine working your entire life, accumulating $1,000, believing you are secure, only to discover a decade later that your money buys barely half of what it once did. And here's the most insidious part. Most people did, to notice it happening year by year, their bank balances increased. Statements look fine. There was no dramatic collapse. Yet groceries, homes, fuel, tuition, and medical care kept getting more expensive. This is what inflation does. It creates the illusion of stability while hollowing out real wealth from the inside. Those who fared well during that era were not financial geniuses. They were owners. They owned farmland that produced crops whose prices rose with inflation. They owned energy companies whose revenues increased as oil prices climbed. They owned businesses that sold essential goods and could raise prices without losing customers. Their wealth adjusted upward naturally because the assets themselves were productive. Meanwhile, savers were unknowingly running in place on a treadmill that was slowly accelerating beneath them. Today, inflation is nowhere near 1970s levels, but the mechanism is exactly the same. At 2.7% inflation, a savings account earning 0.4% does feel dangerous, but mathematically, it guarantees decline. Over 10 or 15 years, that decline becomes substantial. Over 25 or 30 years, it becomes devastating. Younger generations who grew up during decades of subdued inflation tend to think of inflation as a background statistic rather than a real force. But inflation is not theoretical. It is a silent tax that punishes patience when patience is misapplied. It transfers wealth from those who hold money to those who hold assets. And after the extraordinary expansion of the money supply over the past several years, it would be naive to assume inflation is permanently behind us. Even if it remains moderate, its long-term effects on idle cash are unavoidable. Now let's talk about the emotional side of this equation, because most financial decisions are not made on spreadsheets. They are made in the human mind, where fear and comfort exert enormous influence. Holding cash feels responsible. It feels disciplined. It feels like control. You can see the number. You can touch it. You can access it instantly. That psychological comfort is powerful, and it exactly why fear is so costly. Fear convinces people that doing nothing is safer than doing something, even when doing nothing carries a guaranteed long-term loss. Over my lifetime, I've seen fear keep intelligent, hardworking people permanently sidelined. They wait for certainty. They wait for the perfect moment. They wait for all risks to disappear. But certainty never arrives. There is always another concern, a recession, a war, a political shift, a new technology, a new crisis. Markets climb walls of worry, not clarity. Ironically, the moments when investing feels safest, when the economy is strong, unemployment is low, and optimism is widespread, are often the moments when future returns are most constrained, because prices already reflect that confidence. Conversely, the moments that feel terrifying, when headlines scream disaster and prices fall sharply, are often the moments that offer the greatest long-term opportunity. Cash plays a vital role here, but only in proportion. Holding some cash gives you flexibility. It allows you to act when others are forced to sell. It turns fear into opportunity. But holding too much cash transforms flexibility into stagnation. It becomes a bet that fear will protect you when in reality fear is quietly costing you purchasing power every single day. Stocks, despite their volatility, represent ownership in enterprises that continue operating regardless of market sentiment. A railroad keeps moving freight. A consumer goods company keeps selling soap. A utility keeps delivering power. Their earnings fluctuate, but their purpose endures. Over time, well-run businesses grow, adapt, and compound value. When you own them, you participate in that process. When you sit entirely in cash, you opt out of it. Many people believe they are avoiding risk by avoiding stocks, but risk does not disappear, it changes form. Market volatility is visible and emotional. Inflation risk is invisible and cumulative. One feels frightening, the other feels benign. Only one can quietly erase decades of effort without ever triggering alarm bells. I want to be very clear about what I am and am not advocating, because clarity here matters enormously. I am not telling you to gamble, speculate, or recklessly chase returns. I am not suggesting you abandon cash entirely or ignore short-term needs. Cash has a rightful place as emergency funding, as near-term spending money, as dry powder for a future opportunity. But beyond that, cash becomes a melting ice cube. It does to evaporate overnight. It melts slowly, steadily, and relentlessly. The danger lies precisely in how ordinary and unremarkable that process feels. You dawn, wake up one morning and discover your savings are gone. You simply wake up one day years later and realize your money does go nearly as far as you expected it would. I've lived long enough to watch this happen repeatedly across countries, currencies, and generations. The numbers change, but the principle never does. Money that does not work will eventually shrink in real terms. That is why ownership matters. Ownership aligns your wealth with human progress. As populations grow, as productivity improves, as prices rise, owners participate. Savers do not. Becoming an owner does to require brilliance, inside information, or perfect timing. It requires patience, discipline, and a willingness to tolerate temporary discomfort in exchange for long-term gain. Index funds exist precisely because most people need to pick individual winners. By owning a broad collection of productive businesses, you harness the collective output of an entire economy. Over time, that output grows. Dividends are paid. Earnings compound. Prices follow. This process is not linear, and it is not smooth, but it is remarkably consistent over long stretches of time. Cash, by contrast, promises stability and delivers erosion. It offers comfort today at the expense of security tomorrow. I built my wealth not by being fearless, but by being rational. I saved diligently, lived modestly, and invested patiently in businesses I understood and trusted. Anyone can apply that same framework at their own scale. The transition from saver to owner is not reckless. It is necessary. Inflation ensures that standing still is, in fact, moving backward. Your labor, your time, and your discipline deserve better than quiet decay. The greatest financial mistake most people will make in 2026 will not involve speculative stocks or dramatic crashes. It will be the slow decision to do nothing, to sit comfortably in cash while the value of that cash slips away year after year. That loss will not announce itself, but it will be real and it will be permanent.